Hey everyone, welcome back to Corporate Decoder. Today we are diving into the Tax Manage Value Portfolio's latest shareholder report. It is like opening a financial treasure chest hoping to find gold, but sometimes you find just slightly shinier rocks. Spoiler alert, it has been a mixed bag for them. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below. This report covers the period from November last year to April of this year. It gives us a peek into how the fund is doing, what they have been investing in, and what it all costs to keep the ship afloat. You can find additional information about the fund by going to their website or calling them. Let's talk cost. For every $10,000 you had invested, it cost you $34 over the last 6 months. This translates to an expense ratio of 0.68%. Keep in mind this is an annualized number, meaning it's what you would pay if this rate continued for a whole year, and that's the fund's expenses against their assets so that they can do these investments. Now for some key numbers. First up, the total net assets, which are the assets minus the debts, stand at about $935 million. The fund held 71 different investments, and the portfolio turnover rate is 31%. This turnover rate tells us how actively the fund is shuffling its investments. A higher number means more buying and selling, which could mean more taxes. So where is your money actually going? The biggest chunk, over 22%, is in financials. Think banks and investment firms. Industrials, which include companies that make things like machinery and equipment, make up about 16%. Healthcare companies account for almost 16%. Healthcare companies accounts for almost 16% of the portfolio. Real estate investments are only a small amount of this, about 3%. They also have some money in communication services such as media companies, materials used in construction and manufacturing, and energy like oil and gas companies. This spread tells us the fund isn't putting all its eggs in one basket with one particular kind of firm. Taking a closer look, here are some of the individual companies that the fund has bet on. JP Chase is their biggest holding, making up 3.6% of the total investments. Charles Schwab, another big player in the financial world, comes in second at 3.2%, and Home Depot is next at 3.1%. These top holdings show the fund favors well-established names. Now let's walk through the fund's financial statements, but first I will remind you that these numbers cover the first half of the year. Looking at where their money is, almost all of it, close to 99.7%, is tied up in common stocks. They do have a little bit, 0.2% in short-term investments. Looking at how much they have versus what they own, the fund's total assets add up to about $936 million. Total liabilities aren't too high, at less than $1 million. This means the net assets, what is left over for the investors, are at $935 million. Let's talk about the action that happened during these 6 months. The fund brought in about $10.5 million from investments, mainly from dividends. There are expenses including fees for the investment advisors and trustees, totaled about $3.4 million, which leaves a net investment income of $7 million overall. Over the past 6 months, the fund's net assets decreased by over $96 million. At the start of the period, the fund had about $1,031 million, but by the end it dropped. Now here are some performance numbers. We saw that the net investing income was 40%, but they got wrecked from investments with negative 5.58%. Let's peek behind the curtain a bit with some accounting policies. Fair value is key here. They use a method to value their portfolio. They use the last sales numbers and mean prices. Boston Management and Research is in charge of the investing decisions. They get paid a fee based on how big the fund is, starting at 0.65% annually for the first $500 million. During the period, they bought about $313 million worth of investments and sold $303 million. This does not, however, include moving in kind to other investments. In April of this year, they did their taxes. They had more than $465 million in profits. Here's a look at how they measure the value of their investments. They use something they call a 3-tier value system. Level 1 is about matching their investments to identical ones. Level 2 is similar but not perfect. And level 3 is their own assessments. The investments are $925 million at the level 1 prices and about $9 million on the second. Now let's talk about what all these numbers mean. Ted, on the bright side, the fund is well diversified across different sectors, which helps to reduce risk. But their performance took a hit from investments. Also, the fund's costs are very reasonable. On the opposite side, the net decrease in assets from operations and capital transactions could be concerning. Also, a negative investment can indicate poor timing. Did they exit too late, maybe? In summary, this report paints a picture of a fund that is trying to manage market risks while aiming for long-term after-tax returns. However, recent market conditions have presented challenges. Alright, that is our breakdown of the Tax Manage Value Portfolio's latest filing. What is your take on these numbers? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. Don't forget to check out the Discord in the description for even more insights. Thanks for watching and see you next time.